Okay, so study unit 3 is look at the overview of the bond sector and the different instruments that you can find here. Okay, so what is the bond market? Correct. Okay. What sort of bonds can we buy?
What do you want by types? So you can buy like house bonds.
Well, no, not a house bond. Zero coupon or coupon? Bonds with options, bonds without. Okay, so government bonds, corporate bonds. Okay, municipal bonds versus national government. Okay, can a liability be an investment? Of course it is. Of course it can. Okay, so a liability can definitely be investment as long as you're going to be receiving the interest from the liability. Right, on the next page, I've got a note here about the bond, which is a promise to pay. Okay, so how can we use that agreement? Okay, so companies are actually generating money from nothing, right? Why? They're looking at a promise. Okay, so have you thought about that? All loans are actually promises. Okay, and that's why in economics, they look at money supply. Okay, 1, 2, and 3 and all of that. Okay, so you're looking at how much money is being generated in the economy. Here, we're looking at generating bonds. And what is a bond? It's just a promise. Okay, a company says, well, I need a lot of capital to invest in the business, to grow the business. And with the capital that I'm going to be using in the business, will generate more in the future. Right, and then we'll pay you back interest on the loan that you gave today. Okay, how does an individual use a bond? The same thing applies. Okay, what does an individual do when they apply for a home loan? They go to the bank with a what? A promise. Okay, you're saying, well, I need property. Okay, I know I can pay off a certain amount every month. Okay, so your promise to pay is then financed by the bank. Okay, the bank is who? The investor or the bondholder? The investor slash bondholder or the issuer slash borrower?
No, the bank is the bondholder.
Yeah, see, the bank is the bondholder because they're giving you the loan. Okay, you are the borrower. You're borrowing from the bank. Okay, but the same thing applies here. Okay. Right, so what types of sectors do we get? Okay, there's a lot of different sectors in the bond market. Okay, there's no uniform system for classifying the sectors. Okay, this I haven't seen too many questions about in terms of the sectors. Right, they talk about the national bond market, domestic and foreign. They talk about international bonds, okay, offshore. Right, so if I'm looking at internal is within the country. Okay, so if I'm looking at the national bond market, you've got domestic and foreign. Okay, national meaning in the country. Okay, so South African companies issuing bonds, domestic or foreign. Okay, the domestic bond market, domiciled issuers in the country issuing the bonds. Okay, see, domiciled meaning was created in this country. Okay, so a South African-born company in South Africa issuing a bond. Right, the foreign bond market is issuers not domiciled in the country, but they issue bonds. Okay, so that would be a foreign country issuing bonds in the country, in South Africa. Okay, but local issue. Okay, foreign bonds can be denominated in any currency, and the issuers include government, companies, and supernaturals. Okay. External. If something is external, it's outside. Okay, that's the international bond or offshore bond market or the euro bond market. Okay, that's looking at foreign currency denominated notes, okay, in a specific currency, and it's underwritten by an international syndicate. There could be multiple different investors, and there could be jurisdiction, okay, that would be applicable that's outside of maybe South Africa, okay, or outside of any other country, right? And it's unregistered, right? It's not as well, let's say, regulated, okay, purely because It's between different countries, okay, or maybe even large corporates issuing these international bonds. Okay, there's no limit in terms of its how can I say, boundaries, okay, or geographic location. Okay, right. So the first group that they talk about in the textbook is sovereign bonds. Okay, if something is sovereign, it refers to what? Government. Okay, and government is obviously structured in a hierarchy. Okay, so you've got central government, you've got municipalities, you've got maybe provincial. Okay, so it all depends. Bonds that are issued by the central government are called sovereign bonds. Okay, is there a credit rating for the country? Yes. Okay, so will those bonds have a credit rating? Yes. Okay, sovereign bonds have risk. And what risks do we have with sovereign bonds? Credit risk. Okay, but is the credit risk very high or low?
Low. Yeah.
Why?
Because it's less likely for a government to fail.
Exactly. Good. Okay, you don't expect governments to fail.
Yeah.
Okay, you don't expect countries to go bankrupt. Good. Okay, the method of distribution, right, there's a few. Okay, they use multi-price or single price, and that obviously looks at auctions. Okay, so when auctioning off bonds, okay, what is an auction? Let's start there.
So basic, so auction the same as like a normal auction, like with the, so basically you go there and then
You bid.
you bid.
Correct.
And you beat people or you lose or
Yes.
you outbid them.
Correct. Okay, so an auction will have two prices, multi-price or single price. Multi-price means all bid prices are accepted. Okay, so it's like going to an auction and let's say there's, I don't know, furniture.
Yeah.
Okay, and everyone's bidding a different price.
Yeah.
Okay, everyone will get their prices. Right, in terms of a multiple price, all bids are accepted.
So everyone will get the what? Everyone will get their price.
All bids, yeah. So all the bids that were made
Yeah.
will be accepted. Okay, so you're bidding for that asset. Obviously, there's going to be certain restrictions. You can't bid for lower than the cost of the asset. That wouldn't make any sense.
Yeah.
Okay, but any bid at a certain price or above would be accepted.
So everybody who bids basically gets
All
the
bid prices accepted.
Okay.
All bid prices accepted. Okay. Right, single price, all bidders accept the highest yield. Okay, remember this is for bonds.
Yeah.
Okay, so here the bid prices would have been quoted as a percentage. Okay, so those bids are all going to be accepted. Here, all bidders accept the highest yield. Okay, the highest percentage. Okay, because remember we're bidding on these bonds. Okay, how much are we going to be paying for these bonds? We need to place a bid. Okay, ad hoc, meaning as and when. Okay, and that's an auction system. Favorable conditions there would apply. Okay, a tap system where additional bonds could be auctioned. Okay, because remember, a bond is a product. You might not have so much of it. Okay, and if there's a limitation on the amount of bonds that you can issue, right, there will be possibly a cap on the amount that you can issue. If you've got a tap system, you might be able to raise more capital by issuing additional bonds. Okay. Types of securities, you get fixed principal securities, inflation index securities, and treasury strips. Okay, those are all long-term or short-term? More short-term. Why? They're treasury securities. Okay, you can have treasury securities that are long-term and short-term. Because they're treasury, they're looking at government. Okay, so you could take a long-term treasury security and you could split it, okay, or strip it, right, into several strips. Right, so what are bunts and gilts? Any idea? Okay, bunts are German bonds and gilts are UK bonds. Okay, because those are the biggest bond markets, okay, in terms of popularity. Okay, so obviously German bonds are denominated generally in euros. Okay, we look at euros. Okay, and then UK pounds, and then obviously American bonds, right, are called bonds. Okay, so bunts and gilts are just words that are used to refer to German bonds and UK bonds. Okay, so there's the structure that we spoke about earlier, central government. Central government will have lots of other separate, let's say, components of government. Okay, so you could have government agencies, you could have government institutions, you could have government organizations. Right, can they all issue bonds? Yes, they can. Okay, anyone can issue a bond as long as you've got a promise to pay. Okay, so have you ever heard of Fannie Mae and Freddie Mac? Really? Haven't? Okay, but they're mortgage originators. Okay, they're looking at home loans in America. That's what they helped with. Okay, they obviously don't exist now because of the crisis. Okay, but they were like mortgage originators. Okay, almost like your let me think of South Africa. Not Uber the taxi app. Uber the home loan mortgage. The OOBA. The Uber. Okay, the OOBA, not the UBER. Okay, there's two Ubers. The one does mortgage origination. The one does taxi app transport type of thing. Okay. All right. So Freddie and Fannie Mae, okay, were US backed government securities. Okay, looking at mortgages. Okay, mortgage backed agencies. Right, and we know if something's backed by a mortgage, it's backed by what? A loan. Okay, so loans backed by loans. Issuing securities backed by other securities. Okay. Right, so give someone else a loan that someone else is paying off using a loan. Okay, it gets quite complex. Okay, and that creates a problem when the one loan doesn't pay. Okay, because you're taking out loans for security for more loans.
Yeah, exactly.
Right, have you heard of securitization?
So isn't that basically assuming that
Go for it.
Maybe like a security policy type thing?
Yes, okay, so security is referring to collateral, right?
Yeah.
Okay, so using participation, okay, as a form of security to make sure that you spread the risk. Okay, so a collection of mortgages that sell participation in a pool of mortgages. Okay, they use a mortgage pass-through security. Okay, so securitization is just a way to collect separate mortgages into one like entity. Okay, it's like to group lots of loans into one like entity. Okay, a collection of. Okay, have you ever heard of collateralized mortgage obligations, CMOs?
Yes, it's the same thing as
It's similar. The word collateral is key.
Yeah.
So what does that mean? Collateral is
basically
like security.
yeah, it's a security.
Okay, so collateralized mortgage obligation is a method to distribute risk, okay, to different levels. Okay, they call it tranches. Right, so the obligation, okay, different tranches, okay, will be paid out, okay, or a distribution will be made rather to the different tranches, the different levels. Okay, it's quite ironic. So when you do watch the film,
Yeah.
okay.
Well, I actually watched it like this weekend.
Okay, but yeah, once you've watched it, and then you'll see right at the end, there's an important announcement there that, so they tell the story of the crisis and what happened.
Okay.
And right at the end, there's a note there that in today's world, they're still selling the same products they sold in 2008.
Really?
Okay, they're just calling it something different.
Jeez,
Okay. All right. So everything you watched in the film happened back in 2008. Yeah, obviously, the only character that was true is Mike Burry. Mike Burry's character is accurate. The other guys, the Gosling's character is fictitious, but based on somebody. Yeah, the book is actually more accurate. And the same thing with what's his name, Carell's character, also based on someone else. Okay, so the only character that's true in terms of the name and like the depiction is Bale's character. Okay, Bale's character is based on the actual Mike Burry.
Yeah.
No, Mike Burry is the guy that predicted the crisis.
Okay, but then you wrote the book on
I'm not too sure who wrote the book.
Oh.
Yeah, but the book is about the crisis and what happened. Okay, and they've turned it into a film.
Yeah.
Okay, and then right at the end of the film, they actually tell you that I don't know. I can't remember if they gave the actual amount that's being issued, but they mention it. There's a note at the end that the instruments that they sold in the crisis are still being sold today, even after the crisis.
That's crazy.
So it's just something to consider. And the word, I think they called it CBO, if I'm not mistaken, or it might even have been CMO. Okay, but maybe just check and then you'll see. But it's a collateralized mortgage obligation. Okay, it's a way to try spread risk into different levels. Okay, but remember, when the one level fails, all the others are affected.
Yeah.
And that creates a problem. Okay. All right, so how many people were jailed from the financial crisis? Again, if you watch the film, they actually tell you that at the end.
Oh, okay, wow.
Okay, how many people do you think? Okay, so who was responsible for the crisis?
Well, basically, the banks. Yeah.
Yes.
Because they
Okay.
giving loans on loans on loans.
Exactly. Okay, it was very, very reckless.
Yeah.
Okay, because it was focused on greed. Okay, greed was the motive. Okay, and even rating agencies were part of it. Okay, you'll see I don't know, you probably saw that in the trailer.
Yeah.
What's his name? Carell's character goes to the rating agencies.
Yes.
And they ask the rating agencies, what incentive do rating agencies have for giving the banks good credit ratings?
Yes.
And the answer is greed.
Yeah.
Okay, that's what they have, because rating agencies rate these banks and countries.
Yeah.
Okay, so it can get quite what's the right word? Integrated, where obviously the banks rely on the rating agencies and the rating agencies rely on the banks. Okay, so they were both guilty, okay, for creating the problem. Okay, even mortgages, the people selling the loans, okay, so they're state agents, right, selling the loans were also guilty.
Yeah.
Why? Because they wanted a sale.
Yeah.
That's greed.
Yeah.
Okay, and they could get their customers cheap loans.
Yeah.
Okay, so they were also guilty for maybe mis-selling, inverted commas, okay, loans to people who couldn't afford to buy loans. Okay, even in the trailer, you'll see at the end, Carell's interviewing a stripper. Okay,
yes,
and
he's like, oh, but you don't have anything to worry about, you don't have bonds. And then she's like, I have like 3 properties or
yes,
something like that.
okay, so the stripper has like 3 or 4 properties.
Like, I've got a condo, and I've got this,
Yes. Why? Because the estate agent was just selling loans to anyone who wanted it.
Yeah.
Okay, so all of those parties were part of the problem.
Yeah.
Okay, so who's responsible for the crisis? All of those individuals. How many people, how many bankers were actually jailed from the crisis?
Was there, I don't know.
One person.
Really?
Only one person got any jail time for doing all of that. From stealing millions and billions of dollars, only one person went to jail. Okay, and I think they mentioned the guy's name on the film as well at the end.
Okay, but why only him?
Because he was actually not what do they call it? Charged or not charged? Found guilty of reckless behavior.
So
Okay.
everybody
else got big bonuses and carried on with their daily life.
But they were also like part of the
They got bailed out by the public. The public actually paid those bonuses to the people. And that's why you'll see, it's quite interesting because right at the end, we'll probably talk about it more next week when you've seen it. But you'll see Goslick's character, he's the investment banker. At the end, he sits with his nice big check. And he shows, like, he talks to the viewer. Yeah. And then Carell's character, he's the guy with the conscience.
Yeah.
And even the guy with the conscience at the end of the film does something that you might think is right or wrong depending on the situation.
Yeah.
But it was either they cashed in their investment or they didn't. And he chose to cash in his investment. So he also made millions from the crisis. Okay, but he was the one that was looking at, because remember who bailed out the banks, and banks were bailed out. The big banks, Goldman, Morgan Stanley, all the big banks in America were bailed out to some extent.
So was it the government?
The government bailed out the banks. Okay, so taxpayers, the government, they actually bailed out the big banks. And
what's when I did economics my first year, when they were saying was what Obama was doing basically.
Okay.
Like he was saying that he's a good president and everything, but the way he's doing Obama's, like he went and he bailed out a lot of companies.
Okay.
And like it's good for now, but in the future
it's gonna create debt.
It will have a bad effect on the country.
Yeah, because so who pays out those bailouts?
Yeah, we do.
The country, the country pays out.
Yeah.
It's the same thing with South Africa.
Yeah.
SAA, there's lots of talk about SAA. SAA was just given, I think it was an 8 billion rand loan from Treasury. Why? To bail them out.
Yeah.
SAA isn't profitable. SAA isn't operating very well. They're not managing their cash flow.
Yeah.
Because the government is always bailing them out, giving them more and more funds to keep operating. Same thing like Eskom as well. Okay, always asking government for more loans. Okay, more loans to keep operating. Okay, at some point in time, it becomes unsustainable. Okay, and this happened in 2008-9. Okay, when we had the big crisis.
Yeah.
Okay. All right.
Only one person went to jail.
Only one person. Yeah, I forget the name, but you'll see it on the film.
Yeah.
At the end, they actually give you all the facts.
But it actually, like so many people were involved in only one. But like, how much jail time? Like a lot. Or
When we did the ethics course last semester, we looked at it. I think it was 7 years. Yeah, 7 years. But the guy stole, but this was something else. This wasn't the crisis. This was one of the fraud cases that UNISA had as part of the discussion. Okay, so we looked at the information. Okay, so I forget what his name was, but I think it was a French, working for one of the French banks. And the French guy was guilty of committing fraud. Okay, and he stole, I think it was like 10 billion pounds or euros, and he got slapped with I think it was like maybe a 2 billion, not billion, million euro fine, and he got like 7 years in prison. Right. So as far as I remember, when we spoke about there, I think he was already out. He was out of prison after 7 years. So he stole like 8 billion euros.
Yeah.
He paid like a 2 million euro fine, and he sat in prison for 7 years, and he got out, and then he's got what, 8 billion minus 2 million euros. Okay. But whether it's right or wrong, we can't say. But that's how it worked, unfortunately. Okay, so that was I enjoyed the ethics class last semester. It was actually quite interesting because they spoke about relevant things in the world, okay, and how the world has become very lots of grey areas, and that's why they've introduced this course for the accountants, because the accountants need to be ethical. Okay, fraud starts with those accountants. Okay, because if they start manipulating the books, that creates a problem. Okay. All right. So state and local governments, can they issue loans?
Yes.
Of course they can. Okay. You get taxed back debt. Okay. So governments need to finance their spending. Okay. And tax is one way to derive income, and that's what they can use to take out loans. Okay. Revenue bonds. And special bond structures as well. Okay, so government, state, local governments, municipalities, provincial, they can all take out more and more loans. Okay. Right, corporate debt securities. Companies issuing debt by who? Businesses, corporates. Okay, more or less risky than government bonds? More risky, good. Okay, and the reason for that is investment companies have to do some sort of rating, okay, for each of those companies. Okay, and if you're a private company, there's not going to be a lot of information about them. Okay, if it's public, then there's more information. If it's government, then information is freely available. Okay, so you get secured and unsecured debt. If it's secured, it has collateral. If it's unsecured, it doesn't. Okay, you can also have certain enhancements where you could have third-party guarantees. Right, so company A taking out the loan, but you have company B acting as a guarantee. Okay, should company A go bust, company B would step in to help pay off the loan. Okay, that's a third-party guarantee. You get medium-term notes, you get commercial paper, so short-term and long-term instruments. Okay, and also bank obligations, bankers' acceptances. Okay. Right, there's the note about companies and government. Which is actually better? Which is better, companies or government? I actually want to show you something while we're discussing this. Let me put on the Wi-Fi quick. But yeah, which do you think is better, companies or government?
So government.
Why do you say government?
Well, it's less riskier.
Okay.
Basically it's less riskier. Maybe there's no guarantee that even though it's if you say for instance iPhone and iPhone,
private sector, public sector.
Yeah. So investing in that, there's no guarantee that it's going to last forever. Well, I guess there's no guarantee on the government as well, but I mean at least the country will bail out the government, or another country will help a different country.
Yes, okay, that's a good point. Okay, so if you're looking at which is the better investment, it all depends on your perspective.
Yeah.
Okay, so you're looking at a bailout. Okay, so will countries fail? No. Will companies fail? Yes. Okay, so
there's a high possibility of it failing.
yeah, so companies don't have that security in terms of bailouts unless government feels that there is no other choice.
Yeah.
Okay, so back in 2008, governments had to bail out the banks.
Yeah.
If they didn't, it would have been a completely different picture than what we currently have.
Yeah.
Okay, because if more banks went bankrupt, it would have been worse than it actually was.
Yeah, exactly.
Okay. All right, so I want to ask you, how much debt do you think the US government has? Okay, let's start with South Africa. How much debt do you think SA has? Yeah, how much debt do you think SA has? Countrywide debt is how much? Yeah. How much million? Rand? Or billion? Or trillion? Which one?
I don't know, let's say 100 million.
Okay, so in South Africa, okay, the country has 100 million rand in debt. Okay, let's have a look at how much the country actually has in terms of debt. Security?
So basically they'll maybe put the collateral on their office or property.
Okay, they use a SPV, a special purpose vehicle. Okay, so they put the assets in a vehicle that'll then pay out. Why? Because they move the bankruptcy away from the actual business. Okay, it's like ring fencing it almost. Right, and then collateralized debt obligations. This is also something they spoke about in the form. Okay, collateralized debt obligations. This is debt on more debt.
Yeah.
Okay, so securities providing fixed income from a portfolio of debt obligations. Okay, so income is being derived from not just one loan, but many, a portfolio. Okay, we've got different markets. You're familiar with this. Primary and secondary, yes? Okay, primary is when we first issue. Secondary is when we buy and sell from other investors. Okay, so the JSE regulates the largest listed debt market in Africa. Okay, at the end of 2013, how many debt instruments do you think we have on the JSE? How many debt instruments do you think we have? Go for a figure. You saw that the entire country has 2 trillion in debt. How much debt instruments do you think we have on the JSE? We've got around, I think it's around 2,000 shares. Okay. So how much instruments do you think we have? More or less than that, roundabouts. Okay. And what do you think the nominal value of the debt is? Nominal value of the debt. approximately number of shares, yeah, around that amount. So obviously instruments, you probably think less, that's what you said. And how much do you think it'll be worth?
Probably more.
Okay, so approximately 1,600, okay, and 1.8 trillion. Right, that's the nominal value of the debt. Okay, and this was back in 2013. Okay, the JSE actually has, okay, 1.8 trillion rand worth of assets. Okay, so is this a big asset class? Would investors look at this asset class? Yes, okay, because remember 1.8 trillion is 1.8 trillion worth of assets that can be invested in. Okay, and someone else's debt is someone else's investment. Okay. Alright, so you've been introduced to the concept of the bond yield curve. What is yield? It's the interest. So what information does the yield curve give?
Well, the yield curve, it's with interest
with time. Good. So it gives you an expectation of what's going to happen in the future. All right. Are financial assets bought and sold without a cost? No. There's always a cost of transaction. Okay. Right. So here we've got a note about understanding the yields. Okay. So what am I focusing on? The yield. Okay. What is the yield? It's the interest rate that I get on that particular bond at a specific point in time. Okay, so there's the note. Interest rates are the yields. It's bond specific. Right, so what will affect the interest rate? Think time value of money.
So then, price of the bond?
No, the price of the bond wouldn't affect the rate.
Then the time will affect the rate.
Okay, time could have effect on the rate because over a long period of time, rates will be higher or lower. Okay, over a short period, they're not going to change much. Okay, what else will affect the interest rate? Will politics affect the rate? Possibly. Okay, location or geography, country. Okay, so there's a lot that can affect the rate. Open market operations. Okay, so is government going to be dealing in bonds? Okay. The discount rate, okay, what's the cost? Okay, reserve requirement, that also affects the rate. Okay, and any verbal persuasion that influences the supply of credit. Okay, so people either take out more or less credit depending on what's happening in the market. Okay, so the market is actually key when it comes to understanding the spread. Okay, because here we're looking at what determines the spread. Okay, the spread is the cost, inverted commas. Okay, something that we need to pay for investing. Right, so here's a note about government. Okay, you've got treasury bills, treasury notes, and treasury bonds. What's the difference? Time. Okay, we go short term and we go longer term. Okay, so the main consideration here is time, but the other consideration is also cost in terms of the rate. Okay, so you get two types. You get on the run issues and you get off the run issues. And on the run issue is the current issue. Okay, so remember, you've issued a bond in the market. That would be on the run. Okay, that would be auctioned in the bond market. Okay, off the run would be securities that have previously been issued that have been replaced. Okay, and when do we replace bonds? When the rates change. Companies may choose to buy them back, okay, and reissue. Inflation-linked or inflation-backed securities exist and they are going to fluctuate in terms of fluctuation in what? In interest. Okay, because remember they're floating. Their interest payments in terms of inflation-linked will change based on inflation, right? It could be backed by inflation or linked to inflation. Okay, so what's the biggest risk for fixed income securities? Biggest risk? What determines the value of a bond? The interest rate, exactly. Okay, so the measure, this is a lot of revision now. Okay, so there is a bit of revision from 2601. It's even the same slides as well. Okay, just adapted for this particular module. Okay, duration is what? A measure of risk. What risk? Interest rate risk. Okay, and if we define duration, it's a measure of sensitivity. Okay, we spoke about it a bit earlier. Okay, we're chatting about it again here. Sensitivity is what? How much does the bond react to a change in interest rates? Do all bonds react the same? No. And because they don't, we need to analyze and we need to measure the duration. Okay, so measuring the duration gives us a view on how the bond will change in the market. Okay. Interest rate risk and price sensitivity. We saw this earlier. It's a summary again. Okay, this I have seen lots of questions on in past papers. There's always a theory question about it. Okay, they either talk about term, coupon, or yield. Okay, it's slightly different in different past papers, but there's always a question that comes out about it. Okay. Right, so remember the concept of risk-free. Is there a risk-free rate?
Yeah.
Good. What is the risk-free rate?
So basically the rate won't change. You're going to get like a fixed rate on that certain amount of period of time.
Okay, think about cap M. What would the risk-free rate be? The risk-free rate will be this, right?
Yeah.
And what would the risk-free be? Where would you get the risk-free?
Would it be given?
It would come from the... It would come from the Treasury or government security. Okay, so there's the note. Right, remember we just said, do governments go bankrupt? No, they shouldn't.
Yeah.
Alright, so the rate that we get on government securities is considered the risk-free rate because we don't assume any risk for governments in terms of bankruptcy, and we assume that government securities are very liquid.
Yeah.
Okay, so high liquidity, no credit risk, that would be considered the risk-free rate of return. Okay, so when the government securities change in terms of rates, your risk-free is actually affected. Okay, that either shifts the graph up or shifts the graph down, depending on whether there's an increase or decrease in interest rates. Okay. Alright, so what expectation can you give me here in terms of the yield? Comment. Give me as much as you can looking at this. Are we going to invest? That's the question. If we are invested, what are we going to do? If we're not invested, what are we going to do? Okay, so there's a few things you could consider here.
Yeah. So basically the short run interest rates rises.
Yes. Okay, so interest rates are rising over the longer term.
Yeah.
So what's the investment strategy? If interest rates are rising in the future,
then the price of the bond will decrease.
so would we look to invest?
Yes.
No.
No. We'll look to sell.
You'd look to sell if you're already invested.
Yes.
Okay, or let's talk about duration. We'd be looking at moving capital into less sensitive bonds.
Yeah.
Okay, because if the price increases, we don't want our bonds to be as affected.
Yes.
Alright, so we'll lessen our exposure or we'll look at less risky bonds. Okay, good. Okay, would we look to invest? The answer is no. Okay, we'll be looking at managing our investments if we have them already. Okay. Is that alright?
Yeah.
Okay. Give me some more from this one.
Oh, was there writing on that other one?
No, there wasn't any writing, it was just a discussion point.
Okay.
Okay? Comments about this one?
So basically the interest rate is decreasing, which means price of the bond will increase.
Okay, good. So current rates in the market are higher than future rates in the market. Okay, so if the bond curve starts to curve down, okay, if we are already invested, what will we look at doing? We'd be looking at increasing our exposure. Okay, or we'd be looking at buying more sensitive bonds. Okay, because when the rate really starts to fall, those sensitive bonds are going to jump in value.
Increase your exposure.
Increase exposure meaning take out more bonds. Okay, so increased exposure means increased exposure has two things: increase the risk that you're exposed to, and also increase the amount of bonds that you're holding. Okay. All right.
Okay, so it was so if you're already invested, you would increase the
If you're already invested, you would increase the exposure because the yield curve is downward sloping. Yeah. You would definitely consider buying more bonds. Okay, if the yield curve started to decrease, yes. Okay, good. All right, and if it's flat?
Well, it's like tricky because I mean, like you could, if you've already invested, then I guess you could invest more if you want, because I mean, like the interest isn't changing.
Yeah, this is actually a turning point. Okay, so when the yield, because remember, the yield curve could have been downward, then it started to flatten out, then it started to go up.
Yeah.
Okay, or it will go up and then start to flatten and then start to go down.
Yeah.
Okay, that's the interest rate cycle. Rates come down, right? Rates go up.
Yeah.
Okay, so if the rate is flat, this is actually a turning point in terms of a hold. Okay, so you wouldn't do anything until you see the graph to curve up or until you see the graph to curve down. You wouldn't do anything. Yeah, you would just wait and see. It's a wait and see signal. Okay.
So if I hadn't invested,
if you were invested, you wouldn't do anything until you've got confirmation that there is something that's going to happen. Okay, obviously you want to see what's going to happen now. Is it going to start sloping up or is it going to start sloping down? Okay, good. Right,
so
what?
Would you say in the normal one, would you sell your bonds?
When you say in the normal, yes, definitely. Okay, normal, you'd be looking at selling or reducing exposure. Okay.
Is that in the normal one? Is that where
because normal means increasing rates.
Yeah. So is that where the issue would
buyback?
No, with the call.
Yes. Okay. Because the issuer needs to protect themselves.
Yeah. So they would implement the call. What is it called?
Call provision.
Yeah, they would implement that in this case.
In this case, in this case, if the rate had to go up, the price of the bond would drop. Okay, so if the price would go, no, that's actually good for the, issuer.
It's the inverted one that they would.
Inverted, the rates are falling. Yes, that was where the call provision would apply. Yes. Yeah, we just need to be careful with the increase in rate and the effect on the price. Okay. Is that alright?
Yeah.
Okay. Alright. Okay, these liquidity preference theories, market segmentation, pure expectation, you've seen before.
Yeah.
Okay, they do test these theories. Okay, so you do need to be familiar with them. Okay, so you know the yield curve gives information about what? Expectation for inflation and changing interest rates. Okay, so how can the curves be explained? It's by using this. Okay, curves are explained based on the theory. Okay, so Irving Fisher came up with the pure expectations theory. Okay, what is the pure expectations theory? It's the link between investors' expectation and the yield curve. Okay, it's looking at long-term and short-term. Okay, your expectation. Right, what the market believes is going to happen in the future. Right, liquidity preference is, do I prefer short-term or long-term? Okay, short-term would be compensated for because it's more liquid than long-term. Okay, so investors want to be compensated for longer-term loans. Okay, because longer-term loans aren't as liquid. Okay, so compensation for that will be different. Okay, short-term would be liquid, so popular. Okay, long-term, not popular, not liquid. Okay, and then market segmentation, supply and demand will affect the rate. Okay, why? Well, not everyone wants a 10 or a 20-year bond. Okay, you might want a maybe 1, 2, 3, 4, 5, and that's where the bootstrapping comes into it. Okay, because you'd have one bond that you would strip into separate other chapters or smaller loans. Okay. Right, what is the risk-free return on fixed income? Risk-free?
Basically investing in the government.
Yes, okay, risk-free is the government bonds. Okay, government bond would be the risk-free interest rates. Okay. Right, we get non-treasury and we get non-government securities. Risky or not risky? Risky. Okay, because those are more corporates. Okay, other companies. Okay, corporate bonds. Right, so if we're looking at jargon, they talk about spread sectors and spread products. Why do we use the word spread? Because there's a risk premium that must be added to the price of that particular bond because it's considered more risky. Okay, so if an asset is considered more risky, you want a bigger return. That's the CAPM, increased risk, increased return. Okay, so how do I measure the actual spread? Okay, the absolute spread doesn't change. Remember, if I get absolute value is always positive. Okay, so absolute is going to be the one minus the other. If it's relative, okay, think about when something is relative, it's compared to something else. Okay, relative to something else. Okay, so absolute, that's the equation. Relative, the same equation, but you've got a denominator here. Divide by the yield on y. Okay, so that's how we work out absolute and relative. Okay, that also is always asked, okay, in tests and exams. It's not a very difficult equation to remember. Just remember absolute is the yield on the one minus the other, okay, and the relative is the same yield minus the one minus the other over the yield. Yeah, always over the second one because you're comparing it to that second one. Okay, so y is the benchmark, x is what's being measured. Okay, so if you're measuring corporate bonds to government bonds, corporate bonds would be x and y would be the government bonds. If you're comparing x to y, okay, it just depends on what you're comparing. Okay, here's a note about spreads. We spoke about a spread earlier. We know the cost. Okay, so the yield spread is the amount between securities that are identical, okay, except for the credit rating. Okay, so yield spreads between securities are identical except for the credit rating. Why? Well, what is the credit rating telling you about the bond? What is its quality? Okay, are all bonds created the same? No. Some bonds are of a higher quality than others. Okay, so bonds that are of a higher quality would be viewed as being more valuable versus bonds of a lower quality. Okay, so the spread is looking at exactly that. Okay, we're looking at this, the quality of the actual bond, the quality spread. Okay, because just think about it. Credit rating is looking at what? The value of, well, not the value, the worth of the bond. Okay. Right, make sure you do know this well because there's always a question about it. They talk about the spreads. If the spreads widen or narrow. Okay, if credit spreads widen, okay, to keep it simple, think about the risk. Okay, think about risk. Right, so if spreads are widening, is there risk or isn't there risk? There is risk. Okay, remember spreads widen because you've got uncertainty. Okay, it's that cost of taking on risk. Okay, so that's how you remember it. Okay, so credit spreads widen in a declining or contracting economy. Why? There's a flight to quality. Okay, so if there's a recession, do people want risk or they don't want risk? They don't want risk. In a recession, people are conservative. Okay, so people don't want bonds in, let's say, high risk type of environment. People want bonds in low risk. And that's why they talk about this as being a flight to quality. Okay, flight to quality meaning, let's buy all the government bonds because they're good quality, they're not going to default. And let's go away from corporate bonds. Okay, because corporate bonds can default. Okay, and in a recession, companies are more likely to close than government. Does that make sense?
Yeah. So where would you buy a government bond?
Government bonds can be bought through a unit trust.
Oh, okay.
Yeah, you can actually buy retail bonds.
Your unit
It's a good
trust,
question.
So your unit trust is basically investing in the government.
Remember, a unit trust is a collective investment. Okay, so we can't buy a 1 million rand bond or a 10 million rand bond or a 20 million rand bond. Okay, and you wouldn't want to just buy one bond.
Yeah.
Okay, so you would buy a fund, a unit trust, or a collective investment, or a fund that would invest in those different bonds. Yeah, so you get bonds that invest purely in, you get funds that invest purely in bonds. Okay.
But then,
Okay, but you said where can you buy government bonds? Yeah. Have you heard of retail bonds? No. You haven't? No. Okay, a retail bond is a government bond. Okay, government issues retail bonds, and it's retail because it's open to the public. Okay, you can go to Pick and Pay and you can buy a retail bond.
Really?
Yes. Okay, you'll probably need to find a shop assistant which would know what you're talking about.
Yeah.
Okay, because we actually test that in investments when we covered this. I don't know if you remember Robert. I don't know if you were ever in class with him. Okay, probably not. Okay, but he was, when we spoke about this, he was like, what? You can buy government bonds from Pick and Pay. You can also buy government bonds, retail bonds, from the post office.
So then you just go there and you say...
You go there, you apply, and you can invest. Yeah, but it's open to the public.
But is it like a lump sum that you invest? Or
yes, it's generally a lump sum. Okay. As far as I know, it could be a debit order as well. Okay, but he actually went and he went to the post office and he asked the assistant, I'd like to buy a retail bond, and the assistant just stood there like blank face. Yeah. But then they did call the manager and they were willing to assist. Yeah.
Oh, okay.
So yeah, if you're looking at retail bonds, but remember, we don't invest in bonds in a low interest environment. You invest in bonds in a high interest environment. Okay, so now it's not the time to look at bonds. Okay, because rates are more likely to rise rather than fall. Okay, give it a few years because interest rate cycle will always go up. Okay, when rates get high again, then that's the right time to start looking at bonds. Okay, right. If credit spreads narrow, what's happening? Is there more risk or less risk? There's no. In terms of? Yes. Okay. No, okay. We said if it widens, okay, there's more risk. Why? Because there's a higher risk premium. Okay, because we're obviously looking at the flight to quality because we want government bonds because they're safe rather than corporate bonds which are more risky. Okay, if they're narrowing, what does that mean? That means government bonds and corporate bonds are both the same because they're both being bought. Okay, there's no additional risk, and that's why the economy would be seen as expanding. Okay, so just by looking at the spread, you can predict if the market is in a recessionary type of environment or if the market is in a expansionary type environment. Okay, just by looking at the spread. Okay, that's why they test that quite a bit in past papers. They either talk about the widening or the narrowing of spreads. Okay, expansion or decline. All right. Will embedded options affect the yield spreads? Embedded options, liquidity, taxability, technical factors, will that all affect the yield spread? Yes, it would. Okay, everything affects the spread because the spread is a measure of risk premium. Okay, it's that additional compensation for taking on more risk. All right, if risk changes, obviously the returns need to adjust and provide for risk. Okay, it has to. Okay, if it doesn't, then it doesn't meet CAPM. Okay, is that all right? Right. Okay, then here's a note about the spreads. We spoke about them. Obviously, two parties can swap. Okay, so swap spreads are looking at derivatives. Okay, they don't test the derivatives in this module. They did in 2601, but it was just introduction. There's a separate module. Yeah, 3703, okay, which is looking purely at derivatives. So don't worry about this. I doubt it will come up. If it does come up, it'll just be theory. The textbook did talk a little bit about swap spreads, okay, but again, not a focus in the exam. Okay. All right. And the last bit, maybe just to introduce this and to cover one or two things before you need to obviously leave. Okay. Study Unit 5, Introduction to the Valuation of Debt Securities. Okay. So here I'm going to test your ability in terms of time value of money. Okay. What is a valuation?
What the bond is valued as.
Correct. Okay. What is the price? All right. So how do I determine price?
Well, you need obviously the factors.
Yes, you need all the variables.
Yeah.
Good. Okay, so yeah, valuation is determining value. We spoke about that. What is something worth? What determines the bond price? We'll see it just now. It's all the variables: the N, the I, the payment, the FE. Solve for PV. Okay. Alright, so with all valuations, what is the fundamental principle with asset valuation? What do we always need to do? We need to determine if we're going to buy or if we're going to sell. Okay, so you need to look at your price and you need to look at the price in the market.
Yeah.
And you need to determine, are you willing to pay that price for that item?
Yeah.
Okay, so what steps need to be completed? We need to determine the cash flows.
Yeah.
Okay, because you can't discount anything back if you don't have the cash flows. Right, so we're present valuing the future cash flows and we're estimating what they're going to be. Okay, you need to know what the cash flows are before you can work out the price. Okay, the price is determined by what you believe will occur in the future in terms of its value. Okay. Right, don't worry too much about the steps. You're going to be doing the steps. They're not going to ask you for the steps. Okay, so they won't say what are the steps needed to value an asset. That's not something that they'll ask. They'll give you information and ask you to get the value. Okay, then you are going to have to then follow the steps or just use the calculator. Okay, all of this gets done on the calculator. That's the nice thing about this. Okay. Right. Okay, so when estimating cash flow, we need to look at the bond in terms of what? What type of bond is it?
Yeah.
Okay, so how predictable are these cash flows? A callable bond. Do we know when the issuer is going to call the bond? No. Okay, do we know when we'll put the bond? Yes, because that's the right to sell. You'll know when you sell your bond. Okay, so here you could get a yield to call and a yield to put. Okay, those are different yields that sometimes comes up in different questions. Okay, if a security is backed by an asset, easy or difficult to measure in terms of cash flow? Difficult.
Yeah.
Okay, so when looking at different types of bonds, sometimes it's very difficult to identify what the future cash flows are because we don't know what's going to happen. If the rate does change, how much is the rate going to change by? Okay, can I predict what the rate is going to be in the next 5 years? You could, but it'll probably be very inaccurate.
Yeah.
Okay, it won't be very accurate. Okay, so that's the challenge. The challenge is, how do we accurately predict what the cash flows are going to be? Because in order to value the bond, I need the future cash flows.
Yeah.
See, that's the big problem with bond calculations. It's dependent on the future.
Yeah, exactly.
Okay. Alright, so what must we use as a rate? Well, it depends on the market. Okay, the rate will always be based on risk-free. What is the risk-free rate? It's a Treasury bill. Okay, default-free securities. Well, when I say default-free, inverted commas. Okay, because even governments have a small percentage in terms of probability of default. Okay, but they're not really likely to default. Okay, and then again, don't forget your basic principles. This is important. You need to know when I have a premium, when I have a discount, when I have par. Okay, obviously looking at the coupon rates and the discount rates. Okay. Are all bonds created equal? No. How do you determine the quality of a bond? No, not the variables. You'd look at its rating. Okay, I didn't write that down. Let's write that down. Rating. Okay, and where does the rating come from? Moody's, Standard & Poor, and Fitch. Okay, so what are they? They're rating agencies. Okay, these guys are looking at debt in different countries. They're looking at debts for different companies. They're determining what credit rating do you have on that particular asset. Okay, is that right? Okay, do we need these fancy equations? No. Okay, I've said it in finance. I'm going to say it again here in investments. You don't need to know all these fancy equations. I've given you both semi-annual and annual. It's not important. What you do need is this: time value of money. Okay, so tell me what you know already based on your previous studies. What do each of these represent?
Okay, so it's present value, future value, payments.
Okay, but what do they represent for a bond?
Oh, for a bond, okay. So basically your present value is what you'll need to invest now.
Which is bond price.
Yeah.
Good. Future value?
Future value is your par value.
Good. Payment?
Payments or your coupons.
Good.
Your N is your number of years. And your I is your
Maturity. 100%. Okay. I've put it up here. If you want to write it down, you can. But you've got a slide here about it. Okay. Alright, so there's the definition. We spoke about this right at the beginning when we looked at bonds and what they are used for. Bonds are used to raise capital. Okay, that's the finance side of things. Right, if they're raising capital, that's someone else's investment. Okay, so when we invest, we are actually buying someone else's promise to pay. Okay, and that's why you've got a contract, a bond indenture. Indenture. Okay, so what will the bond indenture cover? At a minimum, it needs to look at this. What is the face or the par value? What is the coupon? And what is the yield? Okay, remember PV and FE come from that. Okay, the PV is obviously the face value of the par, and you're determining the price. Okay, premium bond if it's above par, discount bond if it's below par. Okay, how do I determine the value of a bond? I discount everything that occurs in the future. I take off future coupons and I take off future face or par value. I take it back in time and I work out what it is. Okay, that's the current price. Okay, just some revision. Okay, you know this. There's an inverse relationship between bond price and interest rate because I is what? The rate that you're using to discount. Okay, so if I discount with a bigger I, what happens to PV? It gets smaller. That's why. Okay, that's why we've got that relationship. The only reason why we've got it is because we're discounting future cash flows. Okay, and I've put a note here. What do I discount? I discount the face of the par and I discount the coupons. Okay, there's the summary. Okay, that's everything that you need to do bond calculations. Okay, and you will see simple, easy bond calculations as well in this module. Okay, the challenge is, can you pull out the variables? That's the challenge. Okay, just remember to keep all the variables the same. And what's the most important one?
I changed like quarters, little half, then I was changing because I was changed my.
Yeah, so which one?
I changed my N and I.
Yeah, so this is the most important variable. Okay, the payment is the most important. Why? Because if I change the payment, I'm restructuring the loan.
Yeah.
I'm going to have to issue a new contract.
But then the payments, I don't change my calculator. Because if I change my
no, when I say payment, I'm saying what time period is the payment in. Okay, so if the payment is quarterly, what do I do to the N and the I?
Then
I change those two to quarters.
Yes.
Okay, but I follow the payments.
Yes.
Okay, that's what I mean by most important. Okay, follow the payment because you can't restructure the loan.
Yeah.
Okay, all right. So let's just do a few of these and then we'll wrap up. Okay, so what's the price? If you know your theory, you can actually give me the answer already.
So it's 1 million.
Why?
Because it's 10% of of the 1 million for your coupon.
Yes.
And your return is 10%.
Correct. Okay, so that's $1 million. All right. Okay, the next one. Oh, this is actually repeat. I've gotten the same slides here. Okay, so yeah, we've actually looked at these already. Okay, I should have taken those out initially, but it's fine. Maybe just write down the answers again here. Okay, this was the 754313. Okay, yeah, we've actually looked at these already. Okay, we don't have to repeat them. We answered them earlier in the.
And then that one is 1171.
1171, yes. 189. Yeah, good. So those ones we can do. Okay, let's look at these ones that we haven't looked at. Okay, so maybe just to test you with the interest rate, if rates rise,
Then pass will
fall. If rates fall,
so rates will pass will increase.
prices will rise. Good. Okay, the yield to maturity is what I get from the start to the finish.
Yeah.
Okay, that arise. Okay. Alright, so quickly work this one out. What do I want here? I want the yield to maturity.
Yeah.
Okay, so that's a calculate I. Insert everything else.
But then, okay, so then I always get confused with the bonds. Which one do I use as a negative? The PV or
Okay, the PV must be negative, then the FV and the payment will be positive. Okay, because you don't want to change 2, you just want to change 1. Okay, so just change the PV to a negative. FV and payment must have the same sign. Always, okay.
And then I use the FV to determine my payments, right?
I use the FV to determine my payments, yes. 10% of the FV will be the coupon. Correct. Yeah, we'll just do these 4 and then we'll wrap up, okay? We'll stop study unit 5, we'll leave for next time.
So 8,76.
Very good. There you go. Great, you've got it. Okay, 8.766 is the I. That's the yield to maturity. Okay, so if I had to hold this bond for the full 10 years, buying it at 1080 and selling it later, okay, or receiving the proceeds, amounts to an 8.76% yield. Okay, 5. Looking for another yield.
So 18,60.
I've got the solution here. Yes, 18.60, perfect. Okay, good. Right, last two, number 6. What am I looking for here? Yeah, but what am I looking for? Yes, okay, PV, good. The bond price. Okay, so now you're going to be solving for PV, substituting in all the other variables.
So 1093783.
No, not quite. Okay, so this is how we would approach it. Okay, have a look at the variables.
Oh, I didn't divide the
Okay.
payments by 2.
Yes, okay, that's the coupon and that's the yield. Is the coupon bigger than the yield?
Yes.
Yes, so premium or discount bond?
So
Premium bond. So see, your answer must be bigger than 500,000. See, that's I'm applying the theory.
Yeah.
Okay, so I know my answer needs to be bigger than 500,000. Okay, then you substitute in, and you do get an answer that's bigger than 500,000.
I didn't do the payments. I didn't do the divided by 2. I just used the 50.
Okay. Okay. Yeah. Just be careful with the compounding.
Yeah.
Right. Okay, so maybe try practice then with number 7. Okay.
Yeah, no, I get
You get it now. Okay, good. So try practice with number 7. Look out for things like that.
Yeah.
Look out for the compounding. Make sure you've got it the same. The N must be the same as the I, which must be the same as the payment. Okay, so long as all three are the same, that's perfect.
So 227.
Very good. Nice one. Okay, so again, the key thing here was the word quarterly.
Yeah.
Right? Everything needs to be in quarters. So N must be quarters, I must be per quarter, payments must be per quarter, and you do get that answer. Great. Okay, Jackie. All right, let's end it there for this week.